Taking Stock, the show where we take stock of the week gone by and prepare you for the next trading week. I am Reema Tendulkar and with me is Anuj Singhal. Anuj, just 3 days in this week, but we've still seen a rally of 1.5% on the Nifty and the Sensex. The mid-caps have outperformed. How did you take stock of the week gone by?
Yeah, I think, Reema, it was a good week. The market could have easily given up 3 or 4%, but the market chose not to. In fact, the market added on. It made a mockery first of that 75.50 mark and is now consolidating at 7,700. The sense you get is that in expiry week, it might well as well make a mockery of the 7,700 mark as well and maybe make a move towards 7,900. Why 7,900 is important is because it's a 200-day moving average. I think if you saw on Wednesday as well, the way the premium surged in late trade, it was indicating that the bulls are in total control right now. And the story was really about a lot of individual mid-caps. Broader market, a lot of broader market stocks, Reema, are, corresponding to the Nifty levels of 7,200 to 7,300. That explains Wednesday's big surge. And my sense is that, over the next 2 or 3 days, you will see a lot more catching up on mid-caps. And towards the expiry, I won't be surprised if the market, reserves that move towards 7,900, maybe as late as the expiry day.
Yes, so but the last 2 trading sessions, we've seen the Nifty recover from its intraday, lows, cut its losses and virtually end at the high point of the day. And by the close of trade, 7,700 plus on the Nifty.
Yeah, that has also been the other key point. The intraday dips have become buying opportunities and the market is not being charitable at all. It's not giving, big dip, that 200, 300 point dip, that hasn't come.
It's just a 50 point dip.
Exactly. That's all the market is going to give. In a market like this, the sense you get is this is that kind of a market which, if it falls, will then not stop. But otherwise, it's just on a one-way journey that we have right now. In fact, we have our guest now joining us. First up, Nilesh Shah, Managing Director of Kotak Mahindra Asset Management, is with us. And in a bit, we'll get Ashwini as well. Nilesh, hi, good to have you on the show. First of all, happy Holi to you and your team.
Happy Holi to you and all your viewers also.
So, much more cheerful Holi than, say, New Year was, Nilesh. What would you say about the last fortnight? It reaffirms, of course, your thoughts that the best way to play the market is via SIPs, play the volatility or use the volatility to your advantage. Do you think the worst is truly behind us and going forward, the market is set to inch higher?
So, from the budget day, we are up about 10%. We are not the only market which is up. Most of the emerging markets has also moved up. We have virtually seen 360-degree opposite behavior in FII. Before 29th of Feb, they were virtually seller on every day. Post 29th of Feb, they have been virtually buyer on every day. So clearly, budget has, kind of given the hope on the path of fiscal prudence. Probably market was a little bit short in anticipation of certain taxation changes related to long-term capital gain. So budget, by not giving that opportunity, created short covering, and then the path of fiscal prudence gave hopes to the bulls and FIIs. And we have seen a nice rally of 10%. Certainly if a market moves in 1 month by 10%, there could be a little bit of volatility ahead. But as of today, as you correctly mentioned, the momentum of market seems to be fairly strong. It dips a little bit, but by day end ends up closing at a higher level. From a fundamental valuation point of view, of course, we are not as cheap as we were on 29th of Feb, but we are not as expensive as we were, say, last year's budget time. So fundamental valuations are in your support. Markets are fairly valued, and hence my feeling is that yes, we could have little bit short-term volatility here and there, but this is all time to accumulate.
Okay, so this is the time to accumulate. Hi Nilesh, and thanks so much for joining in, and happy Holi to you. What about the metal stocks? Hindalco, for instance, has seen a rally of 30% since the start of the month. Tata Steel has recovered close to that since its budget lows. Is it just buying from oversold regions in commodity and select, steel stocks, or fundamentally have things improved?
So today, if we see, most of these metal stocks were available at a huge discount to their book value. Second, there has been some amount of dollar weakening which resulted into commodity prices around the world bottoming out and jumping up. The government also took corrective action, especially in steel sector, by putting minimum import prices. However, when you put minimum import price on steel, of course you end up supporting your steel manufacturers, but then you end up jeopardizing your steel consumers, which are one of the largest exporters from India in terms of automobiles, in terms of engineering goods, in terms of capital goods. So my feeling is that this short-term aberrations in terms of providing support or bouncing back of prices are not really going to drive metal stocks further from current level. They all have bounced quite nicely, 25-30% from bottom. But in order to move forward, they'll be looking forward to fundamental changes in the context of metal industry, which is China's overcapacity. As of today, we don't get the confidence that China's overcapacity is something which is either on the verge of closing down excess capacity, or it will, not follow the path of dumping metal and metal products into rest of the world. So my feeling is that considering the China issue and considering the fact that most of the metal companies in India have a very high leverage, it will be probably worth avoiding this sector. The sector going forward should underperform the market.
Okay. The other theme that really stands out, Nilesh, is autos, and especially the ones catering to the rural sector. We have Hero MotoCorp now at a new 52-week high. TVS Motor has hit almost lifetime highs. Ashok Leyland has hit lifetime high. And while the Nifty is nowhere near the previous highs. Do you think that's the space to be? So much focus was on rural area in the budget. Do you think this could be a bit of a game changer? And would you stay invested in some of these big names?
Definitely, we remain overweight auto sector. You correctly mentioned that today this kind of stocks are supported by the spending in the rural economy proposed in the budget. This sector also will benefit from a good monsoon, which we are likely to receive in this season. More importantly, this sector will also get benefit from the 7th Pay Commission revision recommendation as and when it gets implemented in second half of current year. It should also benefit from the one rank, one pension benefits which are given to the soldiers and retirees. So automobile, by virtue of getting support from the rural as well as the urban economy, should be one of the outperforming sector in our opinion.
Okay. Nilesh, the other theme is pharmaceutical and the way it started underperforming. Dr. Reddy's, Lupin, all ending in the red in the last few days. The risks seem to be mounting, at least from the US FDA front. So what should long-term investors do now?
So one, we must remember that while these companies are getting notices in terms of their manufacturing practices, we are not seeing any product recall. So it is the process which needs to be improved, but the output which comes out of those factories, they are still not being recalled, they are still medically fit for human consumption. The second thing which we have to see is that is there any Indian company which has successfully complied with US FDA norms? And I quote an article in Economic Times where a small company called Windless Pharma in Baddi has complied successfully with US FDA norms through ingenious method in terms of biometric attendance, in terms of taking data of manufacturing straight into the computers and so on and so forth. So if a small company can demonstrate how to run factories in compliance with US FDA, I'm sure it's a matter of time before which the bigger companies will capture it. So pharma stocks are today falling because they were priced for perfection. For almost 5 years, they delivered outperformance over market. It was almost like Mohammad Azharuddin scoring 3 centuries at the beginning of his test career. Obviously, in the 4th inning, he was not going to score a century. And if he was lucky enough to score a 4th century, chances are that in the 5th inning, he would have not scored a century. So pharma companies had outperformed the market, they were priced for perfection, and they've started receiving these notices which kind of give a cause for market to correct. And some of the companies which received notices earlier, they have corrected quite beautifully. And my feeling is that they have taken corrective steps to come back into this US generic business. So if you can build a portfolio of pharma companies, one which have received notices earlier and have corrected, and some of the domestic focused pharma company which is also withstanding the current turmoil where government has banned certain combination drugs, My feeling is that stocks will continue to be volatile in the near term, but it gives you a good accumulation opportunity provided you are a long-term investor. All of us are living quite unhealthy, and our consumption on pharma spending will continue to increase as we move forward.
Oh yes, that point is taken, Nilesh. But the other space which was really, giving big gains to investors this month has been cement. I don't recall when was the last time I have seen a 25% move in Ambuja cement, for example, in a matter of 2 or 3 weeks. The cement was supposed to be a boring sector. What's led to this re-rating in all the large cap cement names?
Essentially, if you see in the cement sector, it's a play on the affordable housing segment, which should get support from the 7th Pay Commission recommendation as people start receiving 75,000 to 80,000 rupees in their hand per annum. They are likely to spend this on EMIs for buying affordable houses. So from the demand side, clearly it looks like that the demand should be increasing in the affordable housing segment. More importantly, government is also taking out some of the cement demand in the road construction sector. This year, road alone should have consumed about 10 million ton of excess cement. So the demand side, road construction, railway construction, and affordable housing are all supporting demand for cement. The second thing is related to supply of cement. Courtesy passage of laws like land acquisition and environment, time taken to put up a cement plant has actually moved from 2.5 to 3 years to probably between 5 to 6 years. So newer capacities of cement is unlikely to come at the speed at which it had come in the past. In fact, if I remember correctly, the kind of cement capacities which we added about 7 or 8 years ago was more than what we have added in last 3 or 4 years ago. I think in 1 year alone we had added more than 50 million ton cement capacity, and now we are adding 10 million and 15 million ton. So your supply is restricted, demand is growing up, and cement as a commodity you can't be importing from abroad. So this whole put together created a nice combination. And the other thing which is happening in the cement sector is that some of the fringe players which were operating to disrupt the market, they are all being taken over by the larger players. So that disruption which was coming into market by fringe players, that also has been demolished to a great extent. Put all these things together and you find that cement is more like a structural story rather than a cyclical story.
Okay, Nilesh, we'll leave it at that. Thank you so much for your time. Always a pleasure to get you in. Enjoy your long weekend. As we slip into a very short break, let's listen into some market opinion that we've heard through the week.
You need to be wary of the fact that you can't find global liquidity flows. You've got to calibrate. You may be pessimistic about our economic scenario. Our economy is struggling. Let's not be any doubt about it. It's struggling. The results of fourth quarter is going to be worse than third quarter, by and large, in most sectors. But you don't find liquidity and start initiating short positions, even though you're not convinced about the valuation. So hold your fire. I think see if the liquidity tapers off, and then we get back into the market.
We always believe that earnings growth this year, that is financial year 17, could be in the region of 10 to 12%. And accordingly, we felt that since the markets were reasonably valued at that point of time, it could move in line with earnings growth and hence could give low double-digit kind of upside for the year. And obviously, beyond 1 year, I think things are much better, and the earnings growth momentum is going to only build on from here. Clearly, I think the earnings improvement is around the corner.
It's difficult to get very, very constructive on markets right now. But then I would say that the opportunity, the scope for a very large crack from here is also rather limited. And that's clearly because our own macros are surprisingly resilient in a global context. Now, they may not be quite the 8 and 9% kind of growth numbers that we were talking about or we were aspiring for when the Modi government came in. But to my mind, the 6.5 to 8% kind of range is a very, very sustainable range, at least for the next 1 or 2 years. I would also say that this is very clearly going to be a buy on dips market.